Now, I have some sad news for you. We are not in Guernsey, but I have been there. I've reminisced to this audience before about the joys of eating lobster in St. Peter Port on my first big journalistic assignment there more than 30 years ago for the Times. Is this former colony of the Duchy of Normandy and paradis fiscal? My palate would suggest it's more of a lobster paradise. But Guernsey is really our springboard today to think about markets and their future on, how do I put this delicately, on this rather more stable side of the Atlantic. Yes, we do all know about the Donald. And I have to say, if you're worried about your blood pressure around the time of Donald Trump's Liberation Day last month, with all those tariffs, it was wise for gentlemen and ladies of my generation to avoid looking at their pensions on an hourly basis, because it wasn't looking very pretty. So there was a lot of turmoil. And interestingly, in a sign of the changed times, we've seen investors looking beyond financial markets by increasing their exposure to the precious metals markets, notably gold, despite the rallying price of the commodity. Now, markets have cooled in the last month or so after President Trump embarked on a semi-retreat. Not that he called it that, of course he wouldn't do that. But all this drama has really come as we're seeing a lot of focus on the rise of tech and AI with both pros and cons. So with that in mind, we can move to our first session where we will be discussing the impact of these trends, notably tech, and how it is driving returns, specifically for the venture capital markets. So there it is, the title of our first panel, How Tech is Driving Venture Capital Returns. And we have Archie Burgess, who is Director of Cibus Capital. Do you know what Cibus means? It's Latin for food. I would like to think that I've known that for a long time, but Archie told me that about 5 minutes ago. We have Mark Harrison from Sprints, we have David Kippen, and we have Woody Stilenman. Now, in case you haven't guessed, I'm in charge, and I'm very strict on timing. So, if I could ask my eminent panelists, please to keep your answers to 3 minutes, please. So, why don't we kick off with Archie? So Cibus Capital are focused on investing in agri-food, a crucial area as we see the US and the UK deepen their trade in this area, though I should say no chlorine-washed chicken coming from the US and no hormone-fed beef either for the UK. Now, one of your aims, Archie, is to improve what you describe the outdated food supply chain. So why is there this need to, why is this more pressing than ever?
Yeah, and it's interesting you mentioned the problem set. And also there's the US-UK trade deal recently where food was very prominent. We have a huge problem set in the food and agricultural system. Just to give you an idea, well, firstly, it's incredibly inefficient. There's about 40% in terms of waste. Demand in terms of food has to increase 60% food production between now and 2050. This is at a time of resource scarcity. You've got soil degradation, we're losing arable land, and so the fragileness, the inefficiency, and also just really the lack of productivity today is a huge problem set that we're addressing through the likes of technology, and Stephen mentioned AI, which is, robotics and AI is a key part of that as well.
Great. Now, David, with these gyrating markets that I was referring to, we all obviously know about risk. But when investing in global infrastructure projects, how do you mitigate as much of that risk as possible in your structuring?
Well, just for context, we are a Guernsey-based investor in digital infrastructure projects, mid-market digital infrastructure projects in Europe and North America. I guess I have a sort of a boring answer for you, which is you start off by buying rights, and what that means is stay disciplined on price, bring sector expertise and operating expertise to the table and doing your due diligence and preparing for transactions. And then starting off at a very rational starting point for the investment going forward. So, there's many things you can do with identifiable risks that are known and controllable in the context of entering into a new investment. There are some other undiversifiable risks that you really have to just build your way back into price. But we've seen in the context of the last several years with low interest rates, money flooding into funds like ours, a proclivity for funds to pay a lot. There were some eye-popping valuations done in our sector 2 or 3 years ago, 25, 28, 30 times EBITDA for digital infrastructure assets. And we stayed at our fund very disciplined. We sort of said, when interest rates go up, there's going to be yield compression and, a few tiers somewhere for investors. And we were quite happy to lose those auctions that went to sky-high prices. So I would say it's stay disciplined on price, understand the ecosystem and the exogenous risks, and then, do appropriate due diligence with the target companies and, build those risks back into your transaction.
You were almost,
Structures.
David, taking us back to that other great Donald in our life at the beginning of your remarks. Do you remember Donald Rumsfeld? the unknown knowns and the known unknowns and all that sort of stuff.
We have used that term in the office more than once. Yeah.
Mark, at Sprinks, you've got a big focus on achieving growth through the best use of tech. So do you think these sorts of tech enterprises are better placed to weather the volatility that we're seeing and generate sustainable capital returns? And if so, why is that?
Yeah, absolutely. So at Sprints, we focused on fast-growing companies that are customer-obsessed, but tech-enabled and tech-driven. And it's the tech that greases the wheels of those companies and allows them to perform and deliver on that customer obsession. And it's the customer obsession in, for example, software, where we focus most of our efforts, that means that you can create products that are sticky. And it's that stickiness of product that means that you will retain and not churn customers. And it means that in downturns and periods of difficulty, there's lower price sensitivity. So if the customer feels they cannot do without that product due to that tech capability that it's providing them, then that means that they won't churn again, and so they will weather the storm. In companies like Vinted, which is one of our most successful companies, the online second-hand fashion marketplace, what we see is tech enables them to drive liquidity of the product. The thing about consumer platforms like Vinted, it's not a retailer, it's an online platform, it's a tech company. And so what they have to do constantly is evolve that technology to drive a good user experience for the seller and for the buyer. And that creates a virtuous circle where the buyer wants to list their product, the seller feels that they want to buy that product, so there's more movement of capital, and then the chain continues to evolve. So one of the things they've been doing is how do they create security for those customers? How do they avoid bots getting on the platform and selling dodgy stuff that they shouldn't be doing? And so they've built algorithms that allow them to identify those up front and hunt down those bots. And that's not just about reputational risk, it's about driving that liquidity. Another example would be Revolut, which is another one of our companies that hopefully a lot of you would use. Revolut basically just drives technological change all the time. It's relentless, it's obsessed with it. To the extent that they could not find an HR platform to deliver on their scientific and data-driven approach to their own recruitment and performance management challenges. So they just built their own. And from there, a year ago, they went to market with a new product in HR, which is quite a fascinating story, I think.
I think we might have heard of Revolut. Archie, if I may, I'm going to go back to you. So clearly tech is a core part of your business and investment model, and I'm told on good authority that your venture strategy is focused on investing into young, innovative agri-food tech firms that are using the latest technology. So tell us, how is Cibus creating value and developing new revenue streams in that way?
Yeah, so we're investing in everything from farm to fork, so anything from genetics, from biologicals to replace synthetic chemicals on farm, robotics and AI. Everyone's having problems with labor forces, especially with migration, especially in the US at the moment, all the way through to kind of more downstream applications. Just to give you one example, I think is really relevant in this situation, which is eco-robotics. So today, in terms of spraying on farm, the sprayer is used more than any other piece of equipment behind a tractor. And now at the moment, it's just broadcast. So you're broadcast spraying chemicals to kill, weeds, etc. With AI and with computer vision, these sprayers are now becoming smart. So they've identified the weed, they see the weed, and they spray only the weed. And that's reducing chemical use by about 95%, It's reducing labor because you don't have to have manual weeding as well. It's increasing the yield of the crop because you're not spraying the crop anymore, so you're not having a detrimental effect to the crop, all at the same time as increasing biodiversity. So it's a win-win for everybody. And with this kind of hardware plus software, which is getting smarter over time, these kind of companies that, are rapidly transforming the food system. So that's one example of, one of the areas that we're spending a lot of time in.
And I can tell you, tractors these days are very high-tech and very big. I was on a farm the other day interviewing Kemi Badenoch on a hay bale. And she went and saw a tractor. It was absolutely enormous. But there you go. Anyway, Woody, your business, RTW, you focus on life sciences investment and innovation. How best do you work with firms to ensure they're making the best use of these new tools available to them?
Thanks, Nick. Yeah, so we're specialist healthcare investors focused on innovative biotech and medtech and companies. So we don't have to really encourage them to use the tools that they need to innovate because it is absolutely core to their own functioning. But if we think about what are the two sort of foundational blocks upon which our industry, our drug development biotech industry has grown, really there's two things. One is genomic sequencing, the declining cost of genomic sequencing over the last 10 or 20 years. Everyone knows about Moore's law and the falling cost of computing power. But actually, genomic sequencing has fallen at a greater rate than would be predicted by Moore's law. And that's really allowed us to understand the true sort of origins of disease in order to develop drugs that can target those diseases. The second point is that we've seen an explosion in the number of new modalities. These are therapeutic techniques to develop drugs. Not only have they been emerged into the world, they've also been proven, obviously, by the FDA. So a combination of those two things, understanding the root causes of disease, and then being able to target those diseases with amazing new innovations, new modalities, is really a bit of a game changer, and what really lies at the foundation of our industry. But talking about tools, I'm going to get an early Guernsey plug in here, talking about tools to really capture VC returns. I think we're actually not quite VC investors. We are what we call full life cycle investors. And we have a Guernsey domiciled fund that is listed on the London Stock Exchange too. So a combination of London and Guernsey, as we were talking about earlier. And it's actually been our best performing fund since we launched it in 2019. And the reason for that is that it gives us the flexibility and duration that you need to be able to capture the most from the long and expensive drug development cycle that we invest in.
Thank you. David, you talk about how the philosophy at Cordiant Capital is build and grow. Let me ask you to reflect on your career and ask how you've seen technology enable that philosophy to deploy those tools that Woody's been talking about.
Well, I was back in the Silicon Valley in the late 90s and early 2000s. I remember the sock puppet well, and I remember Boo.com, if you remember them here in London and others. And that was the first sort of wave of digital everything coming into our lives. Obviously, there's an experiential answer to the question, which everybody understands, which is how, our daily functions, our businesses have automated, how we take digital information into our lives, and it's fundamentally changed us. We've seen that across the board. But the interesting thing now, and I think the AI discussion was very timely, is we ain't seen nothing yet, because we're now at an inflection point where all the data growth rates that we saw in the last several years are now going to go up by big multiples in the next several years. And we don't have actually the infrastructure in the world right now to accommodate that. So where we're investing in our fund, by the way, Cordiant Digital Infrastructure Limited is a Guernsey, as I said, a Guernsey fund listed on the LSE. And that's very appropriate as a listed entity because we need to make long-term investments in some of these technology transitions, both in the physical, building more fiber, building more data centers, building more towers for 5G, et cetera. But there is a big technology element to that as well. So operating fiber systems now, you need to deliver basically much more efficient packages for much more efficient services for much bigger data packages. So GPON is coming into the market. That's a new technology that's going to dramatically lower costs for the distribution end of fiber. DWMD, which is the optical lighting of fiber, can now go 1,000 kilometers and deliver terabits of data. That's a new technological innovation. So those, in addition to additional fiber pipes, are going to be very important for, to accommodate the continued growth in fiber. In data centers, the real big problem is actually energy. And so efficiency in data centers is actually probably the next wave of technology innovation. And bringing down PUEs, which is power utility efficiency ratios. And typically data centers, old data centers that you might be accustomed to from 20 years ago, are sort of 1.5 to 2. That's the amount of power coming in to the amount of power that goes to the server. That needs to get down to 1.1. And that's quite a big dramatic difference, but that will mean a big dramatic difference in the economics of performance in the industry and returns to shareholders too, I would imagine. But I think, as just to round out the thought, being part of a listed entity means that we can invest for the long run. And this investment cycle is going to go on, this transformation for the next 10 to 20 years in our space.
Thank you. It's good, David, that you mentioned Stephen Hillian, because
Yeah.
Woody, I was just going to say that Stephen talked movingly about the impact of COVID on his home city of San Francisco. Luckily, we're out of that pandemic. When's the next one coming along? But how did the pandemic change the way your industry is viewed, as presumably it's not only technology that's brought into focus specializations such as yours?
I think, during COVID, science was beamed into our living rooms, and we were forced to watch it, I suppose, every day. And then we all became aware of a new modality, that term I used earlier, mRNA for the vaccines. And you'd think that would be the beginning of a very exciting period. But actually, from February of 2021 until now, public biotech's been in a bit of a bear market. And actually, if we take the XBI, which is the biotech part of the S&P 500 index, we invest public and private, it's actually underperformed the broader S&P 500 for the last 5 years, which is rather remarkable given all that innovation that I mentioned earlier. 2 years ago, we saw record drug approvals from the FDA. So plenty of innovation, but actually capital has been going out of biotech as an industry in recent times. But I think that really underlies the value of specialism, because clearly when the tide is rising, anyone can make a bit of money, including generalist investors. But when the tide's going out, or when capital is a bit scarcer, then that's really when you need the specialists. You need the understanding of the science, the understanding of, is this drug, what are the probabilities of this drug developing through clinical trials, and really basing that on the science. It really underlies the value of that. So probably not what people were thinking. Specialism and science has beamed into our homes. There was a bear market, but really specialism is what will get us out of it.
Well, it's interesting, Woody, that you mentioned specialism. Look at our eminent panel here. Now, does this specialism suggest that the respective tech that is engaged is different, or is it similar tools just being engaged with and used in a different way?
Is that me?
Yep.
I think it's, I'm sure there, Archie and I, there, in terms of ag tech and so on, there, in the food revolution, there are several technological, genomic sequencing being an example, technological advancements that are equally applied within the sort of broader biotech sphere. But within biotech, actually, there's specialism within that. So at RTW, we've got about 80 people on our team. About 20 of those are PhDs, and they have very specialized expertise in certain fields, whether it's genetics, whether that's in chemistry, you name it. And really, so there's subspecialism within the specialism, if that's not too many specialisms. But I think the one thing clearly that binds it all together right now is using AI as an enabling platform. I think within biotech, it's still yet to emerge as something that will radically transform the industry, because you still need to go through the clinical trials. We still don't know. The point of clinical trials is that we don't know what's going to happen when something gets inside the human body. But AI is definitely a tool, an enabling tool that no doubt all of us will be using to further progress innovation within our various spaces.
Thank you. Let me go back to Mark. So Mark, Stephen Hilliam was telling us that Guernsey combines stability and expertise in financial risk, and that's why Rupert would say that Guernsey is a hub for financial services innovation. So what, apart from the magnificent lobster, attracted Sprints to Guernsey?
Well, I guess firstly I should confess that I wasn't there when the original decision was made for Sprints to come to Guernsey, but I think I can safely say that it was a good decision because we've continued to domicile our funds in the region, and we're raising our fourth institutional fund in Guernsey. And I'm also glad to say that I get to enjoy the weather, which Stephen mentioned. But aside from that, I think that, clearly there's a very robust regulatory framework in Guernsey, which has been long established, but is also flexible, and we work closely with the GFSC when we come across issues that we want to discuss with them. And I think that's obviously a huge tick in the box. I think secondly, it's a region of innovation. The Guernsey PIF that was been mentioned today is something that we've looked at. We've also invested through PCC structures and have explored digitization of funds, continuation vehicles. So Guernsey is certainly a centre for innovation. I think it's got an infrastructure that's been built over decades of talent, and you see that through service providers, administrators, tax, legal. So that's obviously something that is a selling point, but also the fact that it is a relatively small island and kind of that everyone knows everyone in Guernsey mentality, that is actually an attraction because it helps to speed up processes. I think it helps to build trust when you're getting references or working with other providers who you haven't necessarily worked with before. So that actually appeals a lot to us as an investor. And I think in our last LP meeting, we had a slide at the very end of the meeting which described our goals and where we see Sprints moving, and we described ourselves as being a small giant, and I think that kind of fits quite nicely with the Guernsey mentality of a small island, small population, but actually punches well above its weight in terms of being a jurisdiction for investments and funds.
Thank you. So Archie, Mark's small giant thinks that Guernsey has a robust regulatory framework. Cibus has identified, I think, what it calls regulatory pressure as an issue that needs to be tackled. And we'll be talking about regulation in the next panel session. How do you think Guernsey fares on this when compared with other jurisdictions?
Yeah, so we see regulatory pressure across both the portfolio companies in terms of the rise of biologicals to replace synthetic chemicals as an example, and getting these kind of technologies to market. We're seeing regulatory pressures across the board. When it comes to setting up our fund, and one of the reasons why we chose Guernsey, and we're very proud to be one of the first, if not the first, green fund in Guernsey. Our mission statement is to drive resource efficiency and sustainability across the food and ag value chain. And the green fund and this designation, I think, is first of all, it's very practical, and second of all, just on that practicality point, it aligns well with the EU taxonomy without being, too overbearing. So I think it's a good sort of, externally validated designation that has really helped us differentiate compared to other funds. And the GFSC has been, just really incredible in terms of communication, fast and effective, and exactly what we needed when we were looking at establishing this green framework with them for the first time.
Thank you, Archie. Now, we've got a few minutes left, so I'm just going to pick up on what Stephen was saying and his driverless cars in San Francisco, and I can assure you this is not a driverless moderation. You maybe quite like a driverless moderator, but there you go. But let's pick up on what Stephen was saying about AI, and I think I'd be right in saying that I think you're an evangelist. You're an evangelist for AI. So let's just go to the panel and let's ask you about AI. Is AI completely scary, or is it an amazing opportunity, Woody?
Amazing opportunity, but as I said on the last answer, it's there's not been a radical impact on drug development just yet. Drug discovery, before you go into the clinic, I think there are some exciting advances there. But in terms of drug development, you still got to do clinical trials. We still don't yet fully understand what's going on inside the human body. That's why we do them. So it's exciting, and I'm sure there will be advances, but as yet, it's still slightly wait and see.
David, your answer to the essay question du jour, as they would say in Guernsey.
I mean, I have two answers to that. One, AI and these data rates I was referring to before are clearly very good for our business and the investment cycle in digital infrastructure over the next 10 to 20 years, which will continue. The demand will be very heavy. To make AI applications and the demand and much more rational, though, I think we've been behind in many markets on trying to create a regulatory framework that sets up some of the parameters of AI so that entrants into the market and users know what the rules are, and then it becomes much more organized. And Europe and the recent European AI Act have now tried to do that. Europe is, of course, way behind China, the US, everywhere else on AI spending and development, but they are now rapidly trying to catch up with a much more top-down rational framework for AI development and applications. So I think we can expect to see more going on in continental Europe in the next few years as a result.
Thank you, Mark. Your thoughts on this?
Amazing opportunity, obviously, with a maybe touch of scariness as well. I think we're seeing at the portfolio company level almost all of our companies, well, all of them are touched in some way, but some in quite dramatic ways, and are competing with new entrants who are AI first. So they're having to go up the curve quite quickly. I think some of the things that Stephen said that resonated the most was that we're just scratching the surface at the moment. We're really at the very early days, and I think wearing my sort of CFO compliance hat, one of the things that we have to be careful around is obviously data security. Where is your, what you're putting into the system going, and that's something that we're quite careful around. But obviously it's an amazing opportunity, and look forward to seeing what happens next.
Archie.
My view is that it's underhyped. The rate of pace of change compared to all other technologies, I think, before it. It's really accelerating. For us, I think it's more on the physical AI than anything else. We're looking at robotics and the way the robotics are improving, the systems, whether it's picking, to replace the problems we have with the labour force today. That's dramatically increasing in speed and efficiency, much quicker than we expect. So it's kind of already, certainly already happening. It's not just Waymo on the streets, but if you go 2 hours east in the San Joaquin Valley, there's autonomous tractors. And so just, I guess, in physical AI for us is where most of the value add is happening.
Thank you, Archie.